name is Ria. I'm from Yadika 11 Jatiranga Vocational High School from the Accounting Management. Here I will explain the definition of an accounting ledger, ledger accounts, and explain a little about posting to an accounting ledger. Let's go straight to video. What is an accounting ledger? An accounting ledger is an account or record used to store bookkeeping entries for balance sheet and income statement transactions. Accounting ledgers are maintained for all types of balance sheet and income statement transactions. Balance sheet ledgers include asset ledgers such as cash or accounts receivable. Income statement ledgers include ledgers such as revenue and expense. The accounting ledger is used to generate the key financial statements, the income statement, cash flow statement, and balance sheet for the company. What is a ledger account? Ledger account is a journal in which a company maintains the data of all the transactions and financial statement. Company's general ledger account is organized under the general ledger with the balance sheet classified in multiple accounts like assets, accounts receivable, account payable, stockholders, liabilities, equities, revenues, taxes, expense, profit, loss, funds, loans, bonds, stocks, salaries, wages, and others. Also, the ledger book is also known as the book of the final entry. The ledger account is thought of the book that has all the accounting information of the company. Ledger account examples: assets, cash, land, accounts receivable, equipment; liabilities, debt, accounts payable, loans, accrued expense; stock, stockholders' equity, common stocks, retained earnings; operative revenues, sales, service fees; operating expense, salaries and wages, office expense, depreciations expense. Types of ledger. Three types of ledgers. 1. Sales ledger, 2. Purchase ledger, and the last general ledgers. Sales ledger is a ledger in which the company maintains the transaction of selling the products, service, or choice of goods sold to customers. This ledger gives the ID of sales revenue and income statement. Purchase ledger is a ledger in which the company organizes the transaction of purchasing the service, products, or goods from the other business. It gives the visibility of how much amount the company paid to other business. General ledger. General ledger is divided into two types: nominal ledger and private ledger. Nominal ledger gives information of expense, income, depreciation, insurance, and others. And private ledger gives private information like salaries, wages, capitals, and others. Private ledger is not accessible to everyone. This is an example of a general ledger format. Posting from general journal to general ledger is a process in which entries from general journal are periodically transferred to ledger accounts. For the purpose of posting to general ledger, we can divide a journal entry into two parts, a debit part and credit part. Both the parts essentially contain one or more accounts. The amount of the account in the debit part of the entry is read on the debit side of the respective account, and the amount of the account In the credit part of the entry is read on the credit side of the respective account in the general ledger. Example transaction posting from general journal to general ledger. On January 1, 2015, U.S. company sold goods to customer for cash $25,000. The journal entry of the above transaction and its posting to ledger accounts is illustrated below. The debit part of the above journal entry is cash account and the credit part is sales account. So the amount of the journal entry $25,000 is read on the debit side of the cash account and credit side of the sales account. All journal entries are similarly posted to accounts in general ledger. Posting can be made at the time the transaction is journalized to at the end of the week, day or month, or the last as each journal page is filled. When posting the general journal, the date used in the ledger accounts is the date the transaction was recorded in the journal, not the date the journal entry was posted to the ledger accounts. If at any point the sum of debits for all accounts does not equal the corresponding sum of credits for all accounts, an error has occurred. It follows that the sum of debits and the sum of the credits must be equal in value. Double entry bookkeeping is not a guarantee that no errors have been made. For example, the wrong ledger account may have been debit or credit, or the entries completely reversed. Finish the discussion about the accounting ledger and posting the accounting ledger. Hopefully this video is useful for those of you who have watching. Thank you. See you in the next video. Bye bye.